Welcoming everyone who are joining with us through the online 𝐒𝐭𝐫 learning platform. So kicking off things from where we left off last time. Investor relations and capital market leadership. Earnings guidance refers to information about the expected future performance such as potential business plans in the pipeline and their impact which a company discloses to influence investor stakeholders. So every company wants to project a good image. So one of the tools that they use to project a good image would be earnings guidance. So it is one of the tools that every company uses to project a good image, showcasing that their future performance will be better compared to current performance. So why earnings guidance is important is, especially in the context of quoted public companies, the earnings guidance or any information related to future financial performance of a quoted public company directly impacts the market sentiments or the investor sentiments, and these also influence the sentiments or opinions of other stakeholders also, not only the investors who are very keen keen on buying or selling their respective shares. So as a finance professional, this is where you need to be mindful of. You need to check the underlying assumptions of earnings forecasts that the company is disclosing to the general public, and you need to see whether the projections are grounded upon market reality, whether the projections are realistic, or whether the projections are a public relation exercise to obtain more and more further funding from the shareholders. You need to be mindful and see whether the earnings forecasts are in line with the current market reality of the organization, and you need to give assurance to the board that these forecasts are correct and that these forecasts are in line with the current position or current financial position and performance of the organization. So let's say there is a company, the market share is currently 15%. In the next year you are planning to achieve a market share of 50%. So let's say there is a company called company A, current market share is 15%, and you are planning to increase the market share to 50% by 2027. So this is more like an unattainable target if this organization is in a highly competitive environment. So you need to evaluate whatever the projections that are being disclosed in annual reports or other communications. You need to clearly see whether these projections speak the actual reality. One thing that you need to do is you need to validate the assumptions that are emphasized within earnings guidance. You need to validate the assumptions that are mentioned in business proposals, that are mentioned in business projections, to see whether these assumptions are in fact correct. So what you need to understand is earnings guidance or future business projections. So earnings guidance refers to future business projections, future business projections. That is what we identify by the term earnings guidance, future business projections. So you need to see the assumptions, underpinning these future business projections, whether these assumptions are in fact realistic, and you need to verify these assumptions. Therefore, the following needs to be scrutinized. You need to verify whether the forecast related to economic variables. So, the macroeconomic variables can directly impact the performance of any organization. if the GDP is declining, and if the GDP is declining and if you are expecting a 20% revenue growth, then there is a certain mismatch in that. So the country should be growing first of all, then only you can expect organizations and the respective industries to grow and move forward. So you need to see whether the macroeconomic forecasts related to macroeconomic variables such as the GDP growth, exchange rates and commodity prices, that these projections are in fact correct or are in fact connected to the current financial condition. So if the current GDP growth is, let's say, 5%, and if you are expecting a 15% GDP growth for the upcoming year, then that is a completely wrong forecast. So your GDP growth cannot increase or spike like that in a unnatural manner. In an inorganic manner, GDP cannot increase like that. So always you need to evaluate the macroeconomic variables that you are forecasting, and because if your macroeconomic forecasts are wrong, then your business forecasts are also wrong. So you need to first evaluate the macroeconomic variables impacting or that are mentioned in the business forecasts. So what you need to understand is, if the macroeconomic environment is too optimistic, then there is something wrong somewhere. So macroeconomic environment needs to be analyzed. The forecast related to macroeconomic variables needs to be analyzed because these forecasts directly impact your business forecasts. Determine the sensitivity of earnings per share to operational drivers including sales volumes, input costs and capacity utilization. So you need to see how your earnings fluctuate depending on key operational drivers such as your volumes, your input costs and your capacity utilization. So there are key drivers of business performance for any organization. You need to see when these drivers change, how does it impact your earnings, and also you need to see, assess how known but not yet publicly disclosed strategic actions or one-off events are likely to affect the company's future earnings pattern. So there are future incidents that can impact the organization but which are not publicly disclosed. For example, the impact of a pending litigation or the decision taken by the organization to close down a factory. So strategic actions like that which are not yet disclosed to the public but which are known internally, you need to see how those impact the future earnings of the organization. Managing the integrity of performance metrics. So there are alternative KPIs that provide crucial information beyond the information from traditional KPIs. When organizations are unable to show, in order to show a misleading perception, sometimes with the intention of showing a misleading picture about the organization's financial performance or position, what organizations tend to do is, rather than giving the suggested KPIs of performance, they will disclose alternative KPIs of performance, probably with the intention of misleading the investors. So when alternative KPIs are provided, you need to verify them to see whether these alternative KPIs are actually showing the correct picture. So you need to investigate the following. You need to evaluate the recurrence pattern of items excluded from adjusted earnings. So adjusted earnings meaning you take the net profit and you take out the impact of non-recurring items non-recurring items, and the answer will give you the adjusted net profit. So many companies use this formula. To the existing net profit, they adjust non-recurring items and then they disclose the adjusted net profit. Where you need to be mindful is, you need to properly evaluate whether the non-recurring items are actually non-recurring or not by looking at past history. So this is where I have given example. An adjusted profit of 850 million is shown after adding back 150 million one-time charges. So when you further look at the one-time charges, 100 million relates to a board approved restructuring. So every day you will not get a board approved restructuring. So this is a one-off event or one-off expense. So this is okay. And 50 million you add back based on inventory write-downs. This is something you need to investigate. So inventory write-down can occur. It might not be a one-off expense. There is a degree or there is a tendency for inventory write-downs to occur quite often. It was discovered that similar inventory write-downs have occurred in 3 of the past 4 quarters. So in that scenario, you need to take out this 50 million because it is not a one-time event. If you look at the past history, inventory write-downs have occurred. So adjusting the inventory write-down is actually provides a misleading picture in relation to adjusted net profit. You need to direct your team to see, look here, only 100 million you need to add back because that is a legitimate adjustment. So protecting the long-term credibility. So this is where you need to be mindful of when alternative KPIs are provided. You need to see whether these alternative KPIs are in fact reliable. Cross-check operational KPIs such as market share, utilization rates with corresponding revenue and margin movements. So you need to compare KPIs such as your utilization rates, your activity levels, your market share with revenues and your margins. So if your volumes are increasing, and if your revenue is decreasing, there is something wrong somewhere. So you need to compare your financial results with your activity drivers. Again, if your market share is increasing, and if your revenue is still decreasing, that is also a problem that you need to verify. Investigate any conflicts between the narrative in the management commentary and the quantitative data in financial statement. You need to also see whether there is conflicting information mentioned in the management commentary versus what is disclosed in your actual financial statement. So you need to be very mindful of when you are showing adjusted net profit as a performance measure, because there could be recurring items which you can disclose under non-recurring items, which is completely wrong. Financial strategy development and policy formulation. So this is where bulk of our today's discussion will revolve around, more or less. This section looks at the dynamic internal environmental factors. So internal environment meaning things that are internal to the organization, how internal environmental factors impact the financial strategy and financial decision making in organization. And also we are going to look into the framework that we use for translating corporate objectives into actionable financial strategy and policy. So these are the areas that we would be discussing more or less. So when we develop financial strategy, your external environment can impact you, and also immediate internal environment can impact you. So here what we are going to discuss would be internal environmental factors that are directly impacting the financial strategy of an organization. Formulating a financial strategy is the challenge of translating corporate vision into a formal financial structure and framework that allocates capital efficiency while managing the enterprise risk. So when we develop a financial strategy, what you need to understand is any strategy that you develop, any business strategy that you develop should be related to the vision and mission of the organization. If your strategy is not related to the vision and mission, then that strategy will not be a value adding strategy. For example, Apple, one of their strategies would be premium pricing. One of the strategies used by Apple is premium pricing. What if Apple tries to cut down their cost? Wouldn't that impact their brand reputation? Definitely that would impact their brand reputation. So your financial strategy should be directly related to the vision and mission of the organization, like any business strategy. So you have your strategic objectives and you have your vision and mission. Based on the strategic objectives, you determine your strategy, you formulate your strategy. So based on the vision and mission and the strategic objectives, you determine your strategy, and after strategy formulation, you implement the strategy. After implementing the strategy, you have to evaluate and control your strategy. So what you need to understand is how you develop financial strategy also will be like this. How you develop financial strategy also will be like this. Financial strategy development should have a rational methodology, should have a systematic methodology when you develop your financial strategy. It cannot just be wishful thinking. Your financial strategy development should have a proper structure, should have a proper rational and logical basis. This is that logical basis. You have your strategic objectives, corporate mission and vision. Based on that, you develop your financial strategy and you implement the financial strategy, and thereafter you need to evaluate your strategy and take rectification measures. So this systematic framework should be used when you develop financial strategy. The ultimate objective is to create a systematic framework. So there needs to be a logical, rational method when you develop financial strategy, because at the end of the day, why we do that is, at the end of the day, every financial decision should contribute to shareholder wealth maximization or long-term value creation. If your financial strategy is misaligned, then there is a risk of shareholder wealth being not maximized due to mistakes in capital allocation and missing strategic opportunities. If your strategic objectives are something else and if your financial strategy is something else, if there is a clear divergence, then you are not exactly maximizing the wealth and value for your shareholders, and that can lead to taking incorrect business decisions that are not in line with your strategic philosophy of the organization. So always remember, your financial strategy and your vision and mission should always go hand in hand. This is where we talk about the importance of developing a strategic financial architecture. So strategic financial architecture, even though this word sounds a bit complicated, don't get carried away by these words. A strategic financial architecture, in simple terms, is all about having a systematic framework, having a proper logical system that flows down from your corporate objectives to specific financial policies and actions. So, why strategic financial architecture is important is it prevents wishful thinking when it comes to developing financial policies and when executing financial decisions. This is always about having a structured approach where you have a structured rational method for capital allocation and for business decision making. Having a proper structure, having a proper framework for financial decision making with a strategic orientation, this is what strategic financial architecture is all about. So having a proper framework, having a proper methodology where you connect your financial strategy to your strategic decision making, this is where strategic financial architecture will be helpful for organizations. There needs to be proper alignment between strategic intent and financial execution. So your strategic philosophy and your financial strategy can't be two different things. These should go hand in hand. Creating a proper alignment between them, this is where strategic financial architecture will be helpful for organization, because there needs to be proper alignment. So your strategic objectives, and your financial objectives. So let's say financial strategy. So your financial strategy, if I am to map your strategic objectives and your financial strategy, this should go hand in hand. There needs to be a positive relationship. When the so let's say market share. Let's say market share as a strategic objective. So the company wants to increase the market share from 10% to 20%. That is a strategic objective. So your financial strategy should be related to this strategic objective. So this alignment should be there. Then only your financial strategy will be successful. So organizational strategy should be guided by proper alignment. As I spoke earlier, there needs to be an alignment between your financial objectives or strategy to measurable value drivers. So there needs to be proper KPIs. There needs to be proper KPIs to see whether our financial strategy is going according to the plan. You need to see whether the financial objectives are going according to the plan. You need to evaluate your performance. So this is we are looking to this aspect specifically under strategy evaluation. When we need to evaluate and see whether our actual performance is going according to the planned performance. So you need to continuously evaluate your financial decisions. So this is directly covered under strategy evaluation. And your organizational, when you are developing your organizational strategy, you need to evaluate all the strategic options. So there's this famous model that we use, which we call the product market matrix when we develop strategic options. So whether we are penetrating the market, whether we are pushing the product to the market, or are we considering a new product development, or are we considering a new market development, or are we considering diversification as a strategic option. So all of these strategic options you need to evaluate financially. You need to evaluate financially and see which option gives us the highest return. So this is being undertaken, this is being covered within strategy formulation. When you formulate strategies, you need to see whether all the options, whether we have evaluated all the options based on risk adjusted return. So risk adjusted return meaning if certain projects are risky, that riskiness should be incorporated when you evaluate that project or that specific project. So always remember, so for example, when we are evaluating a diversification project, the risk adjusted return needs to be higher because you are taking a huge risk. But if you are pushing the product, if you are pushing your product to the existing market, then the risk adjusted return should be lower because the risk of failing through such action is actually very low if your brand name is good in the market. Prioritization of resource allocation to initiatives with greatest impact on key value metrics. So whether we are actually allocating resources to proper initiatives that is giving us the greatest impact on the key value metrics. So you need to see whether your resource allocation is proper, whether you are allocating the resources to the most productive areas that gives us the highest return. So when we are implementing the strategy, you need to see whether resources are being allocated properly. That is very important. If resource allocation doesn't happen properly, whatever the strategy, even though how good your strategy is, if resource allocation is poor, then your strategy will not give the expected returns to the organization. So that is why resource allocation is very important, especially under strategy implementation. Whether in terms of making operational plans, in terms of resource allocation, in terms of project planning. So you need to see whether proper resources are allocated to proper users. The following aspects should be factored within the decision making of the organization. So you need to evaluate the impact of sustainability and ESG factors. That is very important. So when you determine your strategy, you need to look at the impact of ESG factors. That is very important. If you don't factor in ESG, at some point of time, ESG will come to you as a huge reputational cost. You need to evaluate growth initiatives. So your growth capabilities, your growth initiatives you need to look at when you are developing the strategy, and you need to evaluate cost and benefits of digital transformation. When you are investing in IT assets, when you are investing in IT assets, when you are investing in IT infrastructure, when you are investing in AI capabilities, you need to evaluate the cost and the benefits. So AI is a big buzzword now. So you need to properly see whether getting that technology to your organization, whether that in fact provides the expected benefits that you actually want. Building competitive advantage through financial excellence. Whatever that you do, whatever the initiatives that you undertake, it should provide you with a competitive advantage over the competitors. So let's say you are doing 100 odd initiatives, but that doesn't give a competitive edge over the competitors, then what's the point? Whatever that you do within the organization, that eventually should provide you with a competitive advantage. So if you take 100 business decisions, but the market share hasn't moved the needle, then what's the point? So from a financial point of view, your financial strategy should give the organization a competitive advantage. If it doesn't, then the financial strategy does not make any business sense to the organization. So financial strategy development architecture. So don't get carried away by these huge terms. This refers to a systematic, connected and a rational framework that translates corporate objectives into specific financial policies and resource allocation decisions. So the financial strategy development architecture is all about having a systematic framework, having a proper framework, having a proper system, having a proper framework that converts your strategic objectives into specific financial policies and specific resource allocation decisions. So resource allocation decisions would be your funding decisions. When it comes to where we need to invest money on, when it comes to, this should be investing. So when it comes to where we invest our money on, would that help us to achieve our end strategic objectives? So there needs to be a proper method that cascades down from your vision and mission to your specific financial policies and actions. So this is what we call a financial strategy development architecture. Governing the strategy formulation process. So you need to have a proper strategy formulation process. Here I have highlighted what is the rationale method or what is the rationale model of strategy formulation. So when you formulate a strategy, you need to look at your internal environment, you need to look at your external environment. When you look at external environment, you need to look at the pestle factors, you need to look at the Porter's 5 forces. Internal environment assessment, you need to look at your resources. You need to look at what we call competencies. And also you need to look at the culture of the organization. You need to evaluate the impact of these. And you need to do something called position appraisal. In layman terms, this is what we call the SWOT analysis. By doing this, you need to develop different strategies. You need to evaluate these strategies and then you need to implement these strategies and you need to evaluate these strategies to see whether these strategies are going according to the plan that you develop. So this is the rationale method that we use for strategy formulation. A similar process you need to also use when you develop your financial strategy as well. This disciplined approach links resources directly to competitive advantage or to their best users, but can fail if stages are bypassed or assumptions are not challenged. So if you don't include all your strategy options, what happens? When you don't evaluate all your strategic options, what happens is, the best strategies that you can undertake, you are missing out on them. When you do an improper strategic option analysis. So, this is why this rationale model you need to always follow. If you fail in one area, then the impact to the organization will be huge. So, if you fail even in one area, then the impact to the organization will be huge. Each stage of this process should be carefully managed, preventing strategic drift and ensuring accountability for value creation outcomes. So, what is strategic drift is? Strategic drift is where when your plan and your actual, when there is a divergence between your planned performance and your actual performance based on the strategy that you adopted, if there is a divergence, that is what we call the strategic drift. So, there is a divergence between what you actually achieve versus your planned performance. So, if there is a strategic drift, you need to see why the drift is coming, and necessary people and necessary action should be done in order to make people accountable. So, you need to always follow this rationale model. Then only your strategy, then only your financial strategy development will be proper. This constructing value with a value driver tree. So, you need to use this value driver tree. This value driver tree breaks down your return on equity into further performance measures. So, you have your ROI is a product of your asset turnover and your profit margin. Your asset turnover will be impacted by your operating income and the assets that you hold. Your profit margin will be impacted by your operating income and your earnings before interest and tax. So, you can use the value driver and see whether your operational processes are actually delivering value to the organization. So, this is a breakup that you can use to see where value is created or areas where value is exactly lost. So, in financial literature, we also call this the DuPont analysis. You all would have heard the same under a different name, which we call DuPont analysis. So, the value driver tree and the DuPont analysis both is actually the same thing. Sustainable value creation framework. So, ESG factors, as I mentioned earlier, is something that you cannot ignore in your financial decision making. If you don't factor in ESG factors now, at some point of time, not adopting ESG will haunt you as a huge reputational cost and as a huge reputational burden. So, always remember, ESG factors should be taken into consideration during financial strategy development, because an organization can create value in the long term only if all the stakeholders are satisfied. You cannot create value if your stakeholders are dissatisfied. You can only create long-term value only when all of your stakeholders are actually satisfied. Dismissing material ESG factors as a non-financial cost can expose the enterprise to significant value destruction. So, sometimes you do not pay attention to ESG factors. You think about ESG factors from an accountant's point of view, and you see ESG factors as a mere cost. So, when you do that, what happens is you are exposing the organization to a long-term value destruction. it might come in the form of a penalty. So you saw recently certain issues related to certain pharmaceutical products were being highlighted. Certain issues related to certain pharmaceutical products were highlighted. And regarding Nestle, some of their infant formula were found to be having toxins, and the company had to recall those products. So, not recognizing ESG, what happened? What happened to the brand reputation of the organization? The brand reputation of Nestle, which people had been using for some time, got badly impacted. So, reputational damage. The reputational damage came why? Because Nestle didn't make a quality product. Another good example would be the Nike's sweatshop labor scandal. Nike was using underage labor, and look what happened. Nike had to completely change how they were working and how their factories were operating. So here I have given an example. The sweatshop labor scandal of Nike. Nike was silent on this, and a whistleblower came and exposed the fact that Nike was using underage labor. Look what happened. People started boycotting Nike, and eventually Nike had to correct their malpractices. So, if you don't factor in ESG, what happens is, in the future, ESG will come to you as a reputational risk, which will translate to an unmanaged financial risk. So it is very important that you pay attention to ESG factors. So previously we talked about, so measuring the financial impact of material ESG factors. So this is very important. Material ESG factors such as your electricity usage, your carbon emission, your water usage, whether you are dumping wastages, your wastage collection, your energy efficiency as an organization, these ESG factors, you need to measure the financial impact of these ESG factors. So this is very important, because when you have ESG risks, so ESG meaning environmental, social and governance. So here I have highlighted some ESG risks that can impact the organization. You need to correct the material ESG factors, because if you don't do, the long-term enterprise value will be impacted in a harmful manner. So, an unquantified ESG risk is an unmanaged financial risk which will impact the organization, which could impact the organization negatively in the long term. So, therefore, what you need to do? You need to measure the financial impact of material ESG components. So, you need to evaluate the impact of carbon pricing. Things like fuel efficiency, energy efficiency, your water usage, the wastages that you tend to accumulate in your factory. So, the financial impact of these things you need to evaluate. And if you are developing sustainable products, how your revenue will increase going forward, that also you need to evaluate. So, if we are pushing green products in the pipeline, how that will impact our revenue, you need to look at it. And model the cost of capital correlation with governance scores and ESG ratings from institutional investors. So, in Sri Lanka, of course, we do not have ESG ratings, but in other countries they have ESG ratings from institutional investors. You need to see the impact to your cost of capital. If when your ESG rating go bad, how does it impact your cost of capital of the organization? The next thing that you need to do is validate the ESG linked financial assumptions. So, when you look at ESG initiatives, some of them depend on assumptions or external aspects. The government subsidies, tax incentives. So, in Sri Lanka, we give tax incentives uh, for environmental friendly products, we give tax incentives in Sri Lanka. If you can show that your product creates a positive footprint to the environment, tax incentives will be given in Sri Lanka. So, solar manufacturing got tax incentives. So, like that, when you push green products in Sri Lanka, you get tax incentives. And premium pricing assumptions. So, these assumptions related to ESG initiatives, you need to always verify these assumptions. If the government is giving a tax incentive, how long will the government keep on giving the tax incentive? If we can charge a premium price on our product, how long we can charge this premium price, because competitors also will come up with similar products after a period of time. So how long or how durable these assumptions are, these ESG assumptions, you need to always verify and see whether these, for how long would these assumptions can actually hold. Because if these assumptions are wrong, that can materially impact the project viability. These variables are all often included in projects. Without proper verification, then there is a risk of approving wrong projects that are not in fact giving you a financial return. For example, let's say the government is planning to eliminate the tax incentives for solar manufacturers. So the government is planning to stop the tax incentive for solar manufacturers. So you haven't incorporated that into investment appraisal. What happens? Your investment appraisal will be totally wrong. So always you need to verify ESG related variables, information related to ESG initiatives. You need to always verify and see whether these assumptions related to ESG initiatives, whether these assumptions are actually correct or wrong. You need to validate every ESG related financial assumption before undertaking business decisions. That is very important. Growth strategy, financial planning. So when we have, so I explained previously also, your growth options, you need to evaluate all your growth options. All your growth options you need to evaluate as an organization. How do we do that? By using the NPV analysis. So NPV analysis is what we use when we want to evaluate growth options, whether we are going for market penetration, or whether we are going with a new product development, or are we going with a new market development, or whether we are going with a diversification in terms of our product portfolio. So all of these growth options you need to evaluate by doing a net present value calculation. So what is net present value calculation? All of you all, I hope, have a decent understanding regarding that. This is where you take your cash inflows, you take the present value of your cash inflows after incorporating a discount rate, the forecasted cash inflows, you compare it with the initial investment and see whether the respective project provides us a benefit or not. If the net present value is positive, that means that particular investment is profitable. But the problem with the net present value is you are discounting the future cash flows. So you need to look at the forecast accuracy. Forecast accuracy is very important when it comes to net present value. If your forecast accuracy is wrong regarding cash inflows, then your total net present calculation will be completely wrong. So For all your strategic option evaluation, you need to use the NPV analysis. So you need to evaluate your organic growth strategies and inorganic growth strategies to see which strategy provides the highest value. So when it comes to growth options, there is something called organic growth. So organic growth meaning you are growing the organization by your own capacity. Inorganic growth meaning you acquire a competitor or you acquire another firm. So you are growing by investing money. You are growing the organization by investing money and acquiring other organization. That is what we call inorganic growth. So you need to evaluate organic and inorganic growth and see which option will be better to the organization. Organic growth will give you control, but the bad thing about organic growth is it takes a period of time. If you acquire a competitor, you can easily get that growth by investing money. But the problem is integration and valuation risks is the problem with inorganic growth. Organic growth is slow but reliable. Inorganic growth is fast, but integration and valuation risks will be the problem. So there are many organizations, they acquire other organizations by paying huge sums of money, but integration and compatibility, cultural incompatibility, resource incompatibility, which you didn't factor in before, had led to calling off the merger after a period of time, after paying huge sums of money. So integration, whether the two organizations can work together properly, that also you need to evaluate. So growth strategies and all your growth options you need to evaluate by doing the net present value calculation. So digital transformation financial strategy. So this refers to the strategy or the framework guiding funding of technology initiatives that often generate uncertain and long-term and intangible returns. So all your digital transformation projects, you need to evaluate and see whether these initiatives provide you with the expected returns and benefits. The problem with traditional KPIs is traditional KPIs such as net profit will undervalue strategic technology initiatives. For example, if we want to get a new ERP system, if the organization has to invest in a new ERP system, when you look at it from the traditional point of view, you will discourage investments in IT assets, you will discourage investments in new IT systems because it decreases your net profit. So that is the traditional method of performance evaluating digital transformation initiatives. So accountants by nature look at the impact to the net profit when you undertake business decisions or when you undertake digital transformation initiatives. So this method of looking at digital transformation initiatives is completely wrong. When you only look at the net profit, you will undervalue the strategic benefits that these IT initiatives will bring to the organization in the long term. So those will be completely ignored under traditional performance evaluation methods such as net profit, which will discourage investments in critical IT assets. So where you need to be mindful as an accountant is you need to look at not only the financial benefits, you need to not only look at the financial benefit but intangible benefits, intangible strategic benefits that are provided by digital transformation initiatives you need to factor in your decision making. So you need to change your capital budgeting method when you look at technology uncertainty. Traditional capital budgeting will discourage digital innovation, because when we implement a technology related project, the benefit of that project, for that benefit to realize, it will take a significant period of time. So at the point where you are doing the capital budgeting, you are unaware of the strategic benefits that digital transformation projects will in fact provide to the organization. So the problem of capital budgeting is the capital budgeting techniques such as NPV will be based on fixed assumptions. Before the project is even commercially operational, you are coming up with assumptions about the strategic benefits and the financial returns that the project is able to provide you with. So this method of capital budgeting will not be accurate for digital transformation initiatives. This rigidity forces the organization into either committing too early to uncertain initiatives or terminating them prematurely before their value can be properly tested. So capital budgeting will be inaccurate when you evaluate digital transformation projects. Either you commit too early to a project that doesn't provide you a benefit, or you stop a project before the intended value gets realized to the organization. These two problems can come up when you do capital budgeting for technology related projects. So this method needs to be changed. This rigidity is not suitable for fast moving industries. So you need to come up with agile funding models which are flexible while maintaining financial governance and control. So you need to look at the speed versus the time that you spend on evaluating the project. So in a fast moving business environment, you need to be quick and you need to speeden up your decision making. If not, what will happen is your competitors will outpace you in the market. So your project appraisal techniques also need to be changed. So this is where you need to have agile funding models which should replace traditional funding models such as capital budgeting. So the following should be evaluated. You need to shift to an operating expenditure model from a capital expenditure model. So this I will explain with example. You need to come up with phased funding with specific milestone. If you achieve the milestone, we will do further funding. If you were unable to achieve the milestone, then we will abandon the project. So funding the project based on specific milestones, so phased funding approach will be more suitable. Measure the financial value of flexibility using real option analysis. So we will discuss this further in some other chapters. Certain IT projects or certain projects that you do will give you the option. You can either continue the project or you can either discontinue the project. This option or this flexibility has an inherent financial value. So which we will discuss in further chapters. The value of this flexibility you need to factor in your decision making. So example is given. So when you look at a total cash spending of a digital project over 5 years, so you have done two analysis. You have done two separate analysis for a digital project. Under the capex model, most of the cash gets paid in the first year, with small amounts spent in later years. Under the OPEX model or operational expenditure model, cash is paid evenly. So this clearly shows the difference between a large upfront payment versus smaller regular payments. making it easier to understand the key business trade-off. So you need to use an operational expenditure model when you evaluate digital projects, rather than using a capital expenditure model where the initial investment that you show will be very high. So when you do budgeting, try to use an operating expenditure model for digital projects. So that is the learning point here. Competitive advantage through financial excellence. So financial excellence, as the name itself implies, financial excellence means managing your money well, using your money well, funding your money well, investing your money well, managing your operations well. So financial excellence is all about how you manage your money prudently by using the right mix of funding and running operations efficiently, so that the business gains long-term advantages that competitors find hard to copy. Your financial department should also help the organization to gain a competitive advantage. So a competitive advantage is not only the job of the marketers, guys. Please remember this. The financial department of the organization also have a key role in terms of achieving the competitive advantage for the organization by financially driving the organization. The finance function should not be considered as a supporting function, but should help the organization to develop strategies and to increase the value and the long-term wealth of the organization. The finance division is not just a reporting division, but it should be a division that actively contributes to strategy development of the organization, which in turn increases the value of the organization. When an organization treats the finance division as a compliance or a reporting role, it misses chances to use strong financial management as a competitive advantage and to pursue market opportunities. So, when you financially drive the organization, it will be able to provide a competitive advantage to the organization. So, this is where you need to financially drive the organization in terms of how we obtain funding and where we invest our money. You need to be more participatory in terms of strategy decision making. Financial management has lot more weight. It is not only a reporting role. It is a role that has lot more weight and lot more capability in terms of contributing to strategic decision making. Ultimately, your financial management skills should help the organization to grow, to take advantage of market opportunities, which will provide a competitive advantage to the organization in return. Building advantage through cost structure excellence. So, this means going beyond basic budgeting. It involves carefully redesigning how the business operates to permanently reduce costs. Rather than doing budgeting and variance analysis, what you should do is you need to figure out ways to redesign your business processes so that your costs will be reduced permanently. You need to always see opportunities for cost reduction and ensure that you need to always have a keen eye on how can we reduce the costs, how can we redesign the operations to permanently reduce the costs incurred within the organization. So that is what you need to aim for, rather than doing variance analysis and comparing the actual with the budgeted figures. You need to redesign the business processes so that costs will be reduced within the organization permanently. This involves identifying and eliminating non-value adding activities. So that is one way of reducing your costs. So any activity or process that doesn't add value, you can shut down these activities and using technology and better processes to work more efficient. You can cut down your value adding activities, that is number one. You can use technology to replace your existing operations. So these two strategies you can use to permanently reduce your cost within the organization. Optimizing capital structure for competitive edge. So what you need to understand is the capital structure or the funding structure that you have is managing the capital structure that you have is not only about reducing your total cost of funding, but also the capital structure that you have should help the organization to withstand economic shocks. If your revenue falls, you should have enough capital to manage your operations. So capital structure is not always about reducing your weighted average cost of capital. The capital structure that you hold has a further strategic dimension to it, where the capital structure that you have should help the organization to manage economic shocks. If your key customers, for example, let's take the apparel industry, if USA and UK stop buying garments from Sri Lanka, we should have adequate capital buffer in order to sustain our operations up until we find a new overseas buyer. So capital structure, you should maintain a capital structure that helps the organization to withstand economic shocks and which provides the ability to capitalize on market opportunities. If you see a potential market, your capital structure should help you to fund those market opportunities. There needs to be flexibility within your capital structure where whenever you see a market opportunity, you are able to cash on it. So capital structure has a more strategic dimension to it rather than simply maintaining a lower cost of funding. So the critical factors to scrutinize are, you need to see the impact of your credit rating, how that impacts your total borrowing cost. So for example, financial companies have credit ratings. So compared to the competitors' credit rating, and what is our credit rating and how does it impact our borrowing cost? When we are going to take a temporary OD from a bank, how does our credit rating impact us compared to the competitors? You need to always look at that. You need to see how different debt to equity ratios impact the weighted average cost of capital and the capacity of the organization to fund future strategic investments. And also measure the value of maintaining undrawn credit facilities. So usually organizations have undrawn credit facilities if they see a market opportunity so that they can use it. So whether you have undrawn credit facilities at hand as a buffer so that you can use those credit facilities whenever you see a market opportunity. So these factors you need to always evaluate. So from this point I will finish the lesson. In the next session we will discuss about how key financial policy decisions will be evaluated. What is the framework, what is the system that we use for key financial policy decision evaluation, that we will cover in the next session. So thank you.